Hi folks, looks like you made it. We are now in the last chapter for ACC 4170. So we're going to take a look in this chapter. Again, we're sort of converting over here to the business side of things. So we're going to take a look at property, about acquisition, and cost recovery. And when you're talking about cost recovery, depreciation, amortization, depletion, we're going to talk about when you use what and the different rules regarding it. Okay? So, what are the objectives? Cost recovery methods. Okay, that's number one. What about cost of personal property, real property, intangible assets, natural resources? They're all a little bit different, similar but different. We're going to take a look at makers. Okay, this is tax rules that came from 1986. Makers, by the way, is modified accelerated cost recovery system. That's what that stands for. By the way, if you're an accounting person, somebody says makers, you need to know that they're not talking about the whiskey. Okay, just to let you know. All right, then we're going to take a look about special cost recovery items like Section 179, bonus and listed property. We're going to look at deduction for amortization when you do that, and a little bit about depletion methods. By the way, Section 179, that's immediate expensing, and it changes annually. They kind of use it as one of those things to get people to invest. You know, government plays around with that depending upon the economy. All right, so here's the general rule. General rule. Businesses must capitalize the cost of assets when they have a useful life of more than 1 year on the balance sheet. Okay? Otherwise, you expense them immediately. Okay? So these are typically the names that are used are depreciation, amortization, or depletion. And which one you use, it depends what type of asset you're talking about. Okay. So basically, they use these the whole thing is to recover the costs and to allocate the costs, to allocate it over time. Here they talk about recover the cost of the assets, but in accounting, we know it's really taking the asset and putting it out over time as the asset's being used. And you have to decide the method on that. Okay? So there's different methods. Okay? So when you talk about depreciation, these are tangible personal proper and real property. Notice, other than land. Land is not depreciable. Okay? Now when you're talking amortization, this is for intangibles that have a finite life over a specific period of time. Okay. Otherwise, you don't amortize them at all if they don't have a time frame. You check them for impairment if you remember that from intermediate. Okay. So here we're talking about something that has a finite life. Okay. And then depletion. This has to do with natural resources. I think, and I don't know for sure, but people told me in Dr. Berger's class, you probably talked about some oil and gas, and that would be oil and gas would come under depletion because it's a natural resource. Okay? All right. Now, the basis for the cost recovery. It's about the same as financial. No huge difference here. Once the purchased asset is started, recouping the cost also starts. Basically everything needed to get it going, just like same as financial. And the adjusted tax basis equals the asset's initial basis minus any accumulated depreciation, amortization, or depletion. The one thing to keep in mind is that we're talking about two different sets of rules, two different sets of books. One is GAAP, that's the financial, and the other is tax. So keep in mind, they do similar things, but with two different sets of rules. And that's what gives you those temporary differences. Okay? That when you're accounting for income taxes, that's what creates those temporary differences. So, for example, personal property, that's depreciation. Real property, buildings, forget the land part here. Again, depreciation. Intangible assets, okay? Amortization, again, provided they have a lifespan. Natural resources, as we mentioned, depletion, okay? So here's an example. Scrap Happy is a scrapbooking retail chain. They purchased an old office building for $175,000. Additional $15,000 was spent preparing it for opening, remodeling, preparation for opening. 2 years later, they discovered several leaks in the roof, causing serious water damage. They had to spend $50,000 to get the roof fixed. And then every 6 months, they pay $500 to have their carpet professionally cleaned. And here we're looking, what is the basis of this? Okay, so what did it cost to get everything together? Well, the initial basis, that was the $190, right? So it was the $175 they paid and the $15. Now there's two other transactions. One, this $50,000 re-roofing, this is added to the basis. Remember that whole thing about major component? Okay, so that's added to the basis. So now the basis is $240. Okay, we don't know the depreciation, so without considering that, it's $240. And then what about carpet cleaning? No, that's just an expense. It's routine maintenance. So again, very, very similar to what you would see, at least this part of it, with financial accounting. Okay. Now, the Tax Cut and Job Act made, and that was in 2017, made some changes. Okay. And basically, it had a lot to do with Section 179 and bonus depreciation, okay? And again, remember, Section 179 changes every year, okay? And they made some special provisions. By the way, some of them in 2027 are scheduled. Now, we don't know what's going to happen with this latest election, but some of them are scheduled to be done with, okay? All right, so since 1986, we use this thing MAKERS, okay, but tax accounts, MAKERS. So the thing here is that in MAKERS, they give you look up what type of property you're talking about, and they have a preset amount that's used for depreciation, okay? So to compute MAKERS depreciation, you got to know the assets basis, when it was put in service, what type of depreciation method, the depreciable life, and the applicable convention. And by the way, they talk about how much is deductible in a year. So they have these different charts, basically. Okay, so we're going to take a look at that. Okay, so for personal property, such computers, automobiles, furniture, machinery, anything other than real property. Okay, and by the way, personal property, not real property, and personal use property are not the same thing. Personal use property means it's your property. Personal property means it's property used in a business. Don't ask me why they call it personal. Personal use property is your property. Personal property is property used in a business. And that's not real estate. Okay? So for the depreciation method, there's 3 acceptable methods. Double declining balance, this is probably, in straight line, are probably the 2 you're most familiar with, right? And then there's this 150% declining balance. I'm not sure how many people use that. I'm sure somebody must because they mention it, okay? So for financial accounting, you take an assets recovery period, depreciable life, and it's taxpayer determined estimated useful life. For tax purposes, using IRS revenue 8756, they categorize each based on the description. So on the top one, this is, there you go, put it here. This one is determined by the company. And this right here is by the government. Okay. Okay. By the way, check it out. Once they have determined the appropriate categories, it can use the revenue procedure to identify the recovery periods for all assets in a particular category. Okay. So once you know the category, you just use that straight going on. So here you go. Here are those items. And before, it's going to take a little while to go through this. I'm going to stop it right here. We'll be back with part 2 in just a minute.